chapter in the book. Now they've moved it over to the appendix and made it a little bit more condensed. The downside of that actually is I think it can be a little bit more confusing. You do cover this a little bit more in future business and accounting classes, but it is a really important topic to be introduced to so you start getting comfortable with it. Some students can struggle with how to account for investments. So the learning objectives here, explaining why companies would invest in other companies to begin with. Then we're going to account for equity or stock, so different than fixed income or bond or debt securities. So for equity securities, we're going to show how you do accounting based on how much influence the investor has. So you are the company, you're investing in another company. How much influence do you have based on the size of your investment? So you could have what's called insignificant influence, you could have significant influence, or you can have controlling influence. And each of these three requires a unique set of accounting procedures and rules. So we'll learn all of those. And then we'll finally look at how we account for debt securities, which is a little bit different because the way debt securities work, like bonds, is a little bit different than the way equity securities like stocks work. So why would a company invest in another company to begin with, right? Well, if you look, a company, in this case, we're looking at Apple, right? Apple's balance sheet. If you look, their cash and cash equivalents at Apple is 2,484, and this is in millions. So Apple on September 24th, 2016, obviously this data is a little bit old, has about $20 billion worth of cash alone. And then if you look at their short-term marketable securities, that's another almost $50 billion. And then if you look at long-term marketable securities, so ones that are investments that are expected to be longer than a year, that's $170 billion. It is a massive amount of cash and investments that Apple has. In fact, as it says here in the note, the cash and investments of Apple make up 70% of Apple's total assets, right? A massive, massive amount. Simply because Apple generates a lot of cash and it's able to put that cash to use. So some companies will invest in other companies on a short-term basis, usually just to use excess cash, earn some kind of return so it's not just sitting there earning nothing, right? This way you can earn additional income or raise additional cash later on for operations that come up, things that come up, right? So some of the income that you get is usually interest, dividends, and you may have gains or losses when you sell the security that you invested in. There's also long-term strategic reasons for investing. Sometimes a company wants to buy big chunks of another company so that they can gain influence or control, right? So if you think maybe Apple one day will want to buy Tesla completely, so what they might do is first take a big stake in Tesla so they can start kind of, following it and having a relationship with Tesla before they go in and completely buy it outright. So this is about reporting investments on the balance sheet. Investments can either be short-term, we expect to sell them and get them back into cash within a year, or long-term. Sometimes we hold investments for over a year. Short-term investments will be current assets, again, because we're looking to bring them back into cash within a year, right? So 2 rules here. The investment has to be liquid, meaning I can easily convert it back into cash. It can't be something like buying a building that takes a lot longer to convert to cash. And I must intend, right? There must be intent to convert the cash within 1 year or the current operating cycle. So again, a company like Boeing is probably going to have an operating cycle longer than a year because they're, doing business with airplanes, which take a long time to build. Or use the proceeds from the sale to pay a current liability. If the investment does not meet both of the above criteria, then it's going to be classified as long-term, a long-term asset. So again, equity securities are investments in capital stock, just buying stock of a company, buying an ownership stake in a company. Debt securities are investments in things like bonds or notes payable. So you are basically loaning money to the other company or entity. So three methods that you account for investments, and they're going to be based on how much influence you have. So the rules that were come up with were that if you own between 0 and 20% of another company, we consider that to be insignificant influence. Yes, you can kind of talk to the CEO, maybe have a phone call with them, but there isn't really a lot that you can force the company to do when you own anywhere from 0 to 20%. So for that, we're going to use the fair value method to do the accounting. If you own between 20 and 50% of another company, now we say you actually have some significant influence, right? You can really nudge the CEO and the board of directors to make some decisions that are in your favor. So because of that, we're going to use what's called the equity method, a slightly different method. Finally, if you own more than 50% of a company, you essentially have controlling influence. If you own 51% of Apple, you can fire Tim Cook, right? You are in control of the company. So because of that, what we use is called the consolidation method. And this now, hopefully it makes more sense when you look at a 10K and you look at the financial statements for the company. Oftentimes they will say consolidated statement of net income, meaning not only are they including their own financials in that statement, they're also including the financials of any companies that they have a controlling influence in. So let's look at how we account for things when we have insignificant influence. So this is equity when we have insignificant influence, 0% to 20%. This is just a note from Apple's 10K. So if you want to read it here, they explain what cash equivalents and marketable securities are, right? So good note to take a moment and read just so you understand. And this is found in most companies' 10Ks. Right, the 10K, which is that report we saw in the introduction, and occasionally I've referred to throughout class and the videos. Okay, so first step is we're purchasing some stock in another company, okay? So we're Apple. We buy on June 18th, 2018, we buy 5,000 shares of Intel stock, okay? And that's gonna be a current asset, meaning we're gonna own it for short term. This represents less than 1% of Intel's outstanding shares, so that makes it insignificant influence, right? We're less than 20%. So insignificant influence over Intel. Apple buys the stock for $20 per share, pays $100,000 cash. That's just $20 times 5,000 shares. So how do you report it? At cost. So you debit an asset called investment in securities, in equity securities for the 100,000 we paid. We bought cash, we used cash, so 100,000. So this should be pretty straightforward, just like any other asset that we're buying. Nothing super controversial here. Let's say that we get a dividend now from Intel, right? So June 30th, a few days later, Apple gets a cash dividend of $4,000 from Intel. How do we record it? So date, June 30th, we receive cash of $4,000, we debit cash, right? And we're gonna credit dividend revenue. So we earn some dividends like interest revenue. That is what is receiving a cash dividend. So again, not super controversial. This should largely be a refresh of things we've done before. Here's something new, okay? So here we're going to adjust the equity investments to their fair market value. This is a little bit different in the rules. Historically, like Disney, the land that they bought to build Disneyland, they can't change the value of that land. It sits on the books at historical cost. But when we talk about equity securities and investments in equity securities, the rules are a little bit different. So let me explain with this example. So now we're over to September 29th, okay? It's our fiscal year end. We need to close our books. So we are doing, think of kind of chapter 3, we're doing the final adjusting journal entries before we close the books. The fair market value of Intel stock is now $22 per share. How much did we pay for it before? Let's look. $20 per share, right? So it went up in value. So now it's $22 per share. It has risen in value. So now Apple's investment in the stock has a current fair value of $110,000, right? They own 5,000 shares at $22 per share. That's $110,000. So the investment must be reported on the balance sheet at the current fair value. We need to report it at $110,000. How much is it being reported at right now? $100,000. Where did I get this number? Right here, right? So now we need to have it be $110,000. In order to do that, we're going to write up the investment in equity securities by $10,000, right? If I look at the T account before, this investment in equity securities beforehand was 100,000. Now I'm going to write it up another 10,000 so that it's 110,000, which represents the current fair market value. And I'm going to credit something called an unrealized gain on equity securities for 10,000. Okay, it's unrealized because I still own this investment. I haven't sold it. Once I sell it, I realize the gain. So then I'll have a regular gain on equity securities. But until I've sold it, I have this thing called an unrealized gain. And that's how I adjust the investment to fair value. And so this is called the fair value method because I'm adjusting the investment to fair value. So what I'm going to get is I'm going to have either unrealized gains, as in the example we just did, or if the value went down, I'll have an unrealized loss, right? Again, you get unrealized because it's before the securities are sold, right? So again, before securities are sold, that's why it's called unrealized. You get a gain if the fair market value exceeds the cost, right? The value went up. You get a loss if the value went down, if the fair market value is below what you paid for it. So this is just what I showed earlier. In the T accounts, you started at 100,000, we added 10,000, now we have it on the balance sheet at 110,000, the current fair value. And we're going to have this unrealized gain on equity securities, which is going to go in the other income section of the income statement. And that's going to be a gain of 10,000. Suppose that Apple decides to keep the Intel stock for another year, and during that time, it declines in value. On September 28, 2019, the end of Apple's fiscal year, the fair value of Intel's stock is $21 per share. Okay, so what happened here? So we're keeping it for another year. We had it on the books at $22 per share, or 110,000. Now it's gone down to $21 per share. So our value, 5,000 shares, equals 105,000. And so what do we need to do? We need to write it down by 5,000. So now we're going to debit an unrealized loss for 5,000, and we're going to credit the investment in equity securities by 5,000, again, to do an adjustment to fair value. And if we look at the T account, here we go, here was our adjustment. So now we have a net debit balance of 105,000. And we have this unrealized loss on securities in the other income section of 5,000. And this will, for now, we're going to assume that this is a trading security and it's going to go into the income statement. But you'll learn later that if we call it a not trading security, we'll learn some of these definitions, but available for sale or held till maturity or whatever the case may be, then it's going to be accounted for differently. This other income is going to show up in a special section of the balance sheet rather than the income statement. So you get a realized gain or loss when the investor sells an investment. If you sell it for more than the carrying amount that you have in the T account, you realize the gain. If you sell it for less than what you have in the T account, you realize a loss. So here's an example. So on June 19, 2020, you sell your stake for $107,000. How much was it on the books right now at? $105,000. Where did this $105,000 come from? Right here. Okay, so when I sell it for $107,000, I'm getting cash of 107,000, right? And that's how I suggest you always start journal entries. If there's a cash component, that's usually the easiest one to figure out, right? That's the one we get most comfortable with. So we know that we received cash of 107,000. We need to debit it for 107,000. Then we need to write off this investment in equity security. Why? Because we sold it. We have to get it off of our balance sheet. How much are we going to write off? 105,000. Why is it 105,000? Again, because that's what the value is here. So the difference is going to be a gain or a loss. In this case, the difference is on the credit side, 2,000, so it's a gain. So now you see we just call it a gain on sale of equity securities. Again, it's going to go into this section called other income. And we sold investments at a gain. Because it's realized now, we don't have this word here that says unrealized, right? Because we actually sold the investment. So let's talk about how the accounting looks when we have significant influence. So the equity method gets used when we own between 20 and 50% of the other company's voting stock, right? And I won't go into the details here of voting versus non-voting, but just assume between 20 and 50% of stock, and we'll just assume it was all voting stock. Now, you as the investor may significantly influence the business. Very often, you will hear this in the marketplace. It's called affiliates. This company is my affiliate, usually means I own a significant part of the stock of that company. So I'm a big owner, but I don't own all of it. In this situation, any profits and losses of the investee, that's the company I'm investing in, are going to be recorded as part of the investor's income on the income statement. So this takes a little bit of time to kind of get a grasp around, but if you think about it, you are buying essentially the stockholders' equity when you buy another company, right? When you're investing in another company. So whatever affects the stockholders' equity of that company also will affect your investment. So maybe sounds like a lot of gibberish, but hang in there with me here. So let's say that on January 1st, 2018, Intel buys 49% of IM Flash Technologies. They pay $490 million. What will the journal entry be here? This is straightforward, just like before. We're going to call it equity method investment, just to clarify what it is. Obviously, in the real world, they would probably just call it investment in IM Flash Technologies. But for book purposes, we'll call it equity method investment, so it's clear what method we're using. We paid $490 million, and we used cash, $490 million. So we just purchased the equity method investment. Nothing different here. So here's going to be the first part that's different, okay? So IM Flash Technologies is going to report net income of $300 million for 2018. So what we're going to do as Intel is we're going to take our ownership number, 49%, and recognize that 49% of income of that 300 million. So that 300 million of income was IM Flash Technologies 2018 income. We own 49% of the company, so that's how we're going to show 147. We're going to write up our investment, our equity method investment, by 147. So again, stick with me here on why. If I bought 49% of this other company, think of it like I'm buying the stockholders' equity of this other company. Well, what does net income do to stockholders' equity? Well, net income increased retained earnings by 300 million, right? And retained earnings is part of stockholders' equity, so stockholders' equity went up by 300 million. I own 49%. So it's like my share of the stockholders' equity went up by 147. And I'm going to call this equity method investment revenue, 147. So that's how we record the investment revenue. So what about when IM Flash pays a dividend? So in this case, IM Flash declares and pays a cash dividend of 200 million. So we own 49%, so we're going to receive 200 million times 49%, which is equal to 98 million. So that's how much cash we received. Are we going to call this dividend income? No, we're actually going to write down the value of our equity method investment for by 98. Crazy, right? But again, take a moment to think about what I said before. I'm buying part of stockholders' equity. What happens to stockholders' equity when we pay a $200 million dividend? Well, it goes down by 200 million because retained earnings decreases by 200 million. So my investment of 49% in this other company's stockholders' equity, right, of 49%, that investment went down in value by 98 essentially, right, because I paid out this dividend. So it's as if it went, but economically, all that happened was 98 came out of this investment and went into my cash pile, right? But that's why we call this the equity method investment, because we think about it like we're buying part of the stockholders' equity of the other company. So here we go on the T account in this equity method investment. We bought it for 490 million. We showed a portion of net income of 147, which increased the value of this company, of our investment. The company paid us dividends of 98, so we showed 98 million of cash coming in, but we decreased the value of our investment by 98. So our net balance, when we report our December 31st, our ownership stake in this IM Flash Technologies is now 539 on our balance sheet. So let that sink in, go back and review this, watch it again if it would be helpful. So again, on our balance sheet, we're going to have equity method investments here, and we're going to have equity method investment revenue. This came from the 49% times the 300 million that IM Flash Technologies had of net income. So here's the T account without numbers and just words. We're going to debit the original cost, debit our share of the income. We'll credit our share of any losses. So if the company doesn't have income but instead has losses, then obviously that's going to be a credit. And then any dividends we're going to credit. And that gives us our ending balance here. So what about when we have something called controlling influence? If we own more than 50% of the voting stock, we can basically elect members to the board of directors and we can control policies, right? If I own 51% of Apple, I can get Tim Cook fired if I wanted to. So I, as the investor, am called the parent company because I control it. I am the parent. The company I have the investment in, the controlling investment in, would be referred to as the subsidiary. So here's a real world example. Some of you may have heard of McAfee Inc. They're kind of the virus protection company. And so they have a really interesting history because they have a very colorful founder. If you remind me in class, I'll try and show you share a little bit of history on the founder of McAfee. It is a guy named John McAfee. But anyway, so there's a bunch of investors, the stockholders. They own Intel Corporation, and Intel Corporation actually owns McAfee Inc. And the reality is Intel actually has controlling equity interests in about 30 other subsidiary corporations when you look at the end of 2016, maybe even more now that we are in 2019. So here we can see some of these other subsidiaries, Wind River Systems, Intel Europe. These are separate companies, but sometimes they use the name Intel, sometimes they don't, like Wind River Systems. What we need to do here is consolidation accounting. You really dig into consolidation accounting in advanced accounting classes. I didn't take this until I actually went to graduate school at the University of Chicago. So, but at this level, at least you should be introduced at what happens. So consolidation accounting is a method of combining the financial statements of all companies controlled by the same stockholders. So what you get is a single set of statements as if the parent and subsidiaries are one company. So if you go to Intel, you're going to see consolidated statement of net income, right? Or sorry, of net income, consolidated statement of operations or consolidated statement of income, something, or consolidated balance sheet. So all the numbers of all the companies are in there. Any intercompany accounts get eliminated. In other words, if I am consolidating the financial statements, it makes no sense to have an account payable to myself, right? So any kind of the account payable and account receivable between the two companies get eliminated. Finally, what happens when we talk about debt securities? So equity, we own a portion of the company. A debt security is when we're giving a loan to a company. This can be a struggle. In this Appendix E, we are talking about investing in bonds, and we're going to show interest revenue. When we get to Chapter 9, we're going to be the opposite side, the issuing corporation, the one that issues bonds and is going to pay interest expense. Okay, so right now we're focusing on investing in bonds, and we're going to show interest revenue. So there's 3 categories of investments in debt securities: trading, available for sale, and held to maturity. If it's a trading security, usually the company's intending to hold it for less than a year. You're buying and selling it, right? Available for sale, meaning it's available. I'm willing to sell it at some point. I probably will hold it more than a year, but I'm not going to hold it until it matures. Remember, debt securities have an end date. They're a loan. At some point, you want your money back. That's different than equity securities. If I own stock in Apple, I can hold it for 100 years, pass it on to my grandkids, to my kids, whoever. But held to maturity is specific to debt because there is a maturity date, a date at which you get your money back. For held to maturity securities, we're going to do what's the amortized cost method, okay? So we're going to receive interest semi-annually. This usually gets issued in $1,000 denominations. The price gets quoted as a percentage of par, and the value is going to fluctuate with market interest rates. If the face rate, the rate that's on the contract, is less than the market rate, so the market rate is greater than the face rate, this bond is going to sell at a discount. If the market rate is less than the face rate, this is going to be at a premium. You really need to read this chapter. Again, this Appendix E tries to make this in a much shorter version, which sometimes makes it more confusing because we're skipping a lot of mini steps. But definitely you have to learn some terminology here and work through this appendix a little bit longer. So let's just go through an example, and hopefully that will make sense. So Intel purchases $10,000, right, of 6% CBS bonds. So this is the face rate. At a price of 95.2. Again, because it's quoted as a percentage of par. So par would be 100, right? And in this case, so it's 100% of the value. In this case, the price is 95.2. And I'll show you in a second how you calculate how much Intel paid for these CBS bonds. The face value of them is 10,000, but they didn't pay 10,000. They actually paid 9,520. And I'll show you that in a second. Intel intends to hold the bonds until their maturity date. They mature April 1st, 2022. The interest dates are semi-annual, twice a year, April 1st, October 1st. The bonds mature on April 1st, 2022, so they'll be outstanding for 4 years or 48 months. So let's go through the journal entries of this example. So read through this example again. Make sure you follow all the detail. So here are the journal entries. First, I'm buying the bond. So I'm buying $10,000 worth of face value at a price of 95.2%, which in decimal form is 0.952. So I paid $9,520 for these bonds that have a face value of $10,000. So I paid with cash $9,520. That's that. I'm going to get interest every 6 months, okay? How am I calculating that interest? The interest gets calculated based on the face value, 10,000, times the face rate or the coupon rate, 6%, times how many months do I get interest for? Well, this is from April 1st to October 1st, so 6 months, 6 out of 12. So if I do this math, I get 300. That's how much cash I get for interest, and I show interest revenue 300. And that's my semi-annual interest. I have one more thing I need to do. I bought $10,000 worth of bonds for $9,520. I got a $480 discount. The accounting rules require me to take this discount and amortize it over the life of this bond. So in this case, it's 48 months. So 480 divided by 48 equals 10. So I'm going to amortize $10 per month of this discount. Okay? And what I'm going to do is I'm going to hit this investment, held to maturity investment in bonds account by $10 each month. In this case, from April 1st to October 1st is 6 months. So that's why you multiply times 6. So I'm going to write up my investment in held to maturity investment in bonds by 60 because I need to amortize this discount of $480. Same thing if I had a premium, just the opposite. This would be a credit instead of a debit. And that $60 is going to be called interest revenue. Because effectively, what happens here? The reason I only paid $9,520 for this bond is because this bond is offering me an interest rate of 6%, which must be lower than what I can get in the marketplace for the same risk level of investment. So the only way I'm willing to invest in this bond is by paying less than what you're going to pay me back at the end. So this is kind of like built-in additional interest. And so that's why I'm showing this amortization as interest revenue. So let's look for Intel now at year end. Remember, we have to do our adjusting journal entries, chapter 3 stuff, right? Accrual accounting. So we get to December 31st. I need to show from the last journal entry I did was October 1st. So I have October, November, December, 3 months. I need to show that I earned interest on my bonds, 10,000 times 6% for 3 months, October, November, December. That's going to accrue my interest revenue. And every time I do an accrual of interest revenue, every time I show my interest revenue, I'm also going to amortize more of that discount. So the same thing, that $480 divided by 48 equals 10 times 3 months equals 30. And so I'm going to amortize by writing up my investment. So slowly my investment, this $9,520 on my books is slowly going to $10,000 at the very end. So what's happening here on my financial statements for Intel Corporation, I'm going to report the following stuff. So I'm going to have under my current assets, this interest receivable of 150. That's just right here. Right? My held to maturity investment in bonds, that's what I paid for them. Remember, October 1st, I amortized up by 60. December 31st was another 30. Where did this 60 and 30 come from? Well, here's where the 30 came from. Here's where the 60 came from. Oh, sorry. Oh, sorry there. Let's go. There we go. That worked. Okay. So when I look at my balance sheet, my held to maturity investment in bonds was 95.20 plus 60 plus 30. So now this is what my bond investment shows. I'm slowly amortizing it to 10,000. That's where it's getting to. And in my income statement, I'm also going to have my interest revenue. 300, 60, 150, and 30. Where did all these four numbers come from? 300, 60, 150, and 30. And so I earned interest total of 540 from this investment. So again, this is a condensed version of an introduction to investments. It's probably going to be a little bit confusing or maybe very confusing. Try and go through it a couple times. You will dig deeper into this in future accounting classes. So this is just a very much an introduction. Probably the most challenging part of this is really getting comfortable with the terminology, what different types of investments are and all that good stuff. So definitely bring some questions to class, and I hope the lecture was helpful.